We'll come back to you in a bit here, but our next guest has been warning of a major downturn in the markets for quite some time. He's David Stockman. He's the former OMB director under President Reagan. Welcome back to the show, David. I got to tell you, when I heard about your warning, I always like to pay attention. But what is it that's different this time around than it has been in other periods where you warned about some of the similar topics that you're talking about right now?
Well, we had other periods in March 2000, and then we had a 60% crash in November 2007. A year later, we were down 70%. So these things reach an inflection point. I think we're there now. I think the market is whistling past the graveyard, trading at 26 times earnings at the top of a business cycle. We're 10 years in. It's almost a record. On the theory that earnings have rebounded and will go even higher. I think that's an illusion. We just finished 2017. Fourth quarter earnings came in at $26.54 a share on a GAAP basis, which is the only honest way to look at them because, corporations have to report that way or they go to jail. Now, I mention that because in the fourth quarter of 2013, earnings were $26.48 a share. In other words, 4 years, 6 cents. That's all. That's not growth. Secondly, they think the tax cut is going to cause some giant rebound in earnings. They're forgetting about the other side of the equation. We're heading into a massive monetary fiscal collision that will cause a yield shock that will turn the market upside down, I think, and also eat into the earnings that are expected from the tax cut. Let me go through it quickly. We will be borrowing $1.2 trillion in the coming fiscal year because they started with $700 billion. They added on $300 billion for the tax cut. Then they've had all these appropriation caps that they've blown. $1.2 trillion, 6% of GDP at this late stage of the cycle. Over against that, the Fed is now full bore into QT, quantitative tightening, shrinking its balance sheet for the first time in 10 or 15 years. Now, that's the issue. It's not the 4 rate hikes. It's that they're going to be dumping $600 billion at an annual rate into the bond market beginning in October. If you do the math, it's $1.8 trillion of supply between the Treasury and the Fed, averaging into the bond pits. It's not going to clear the market at 2.9. I think it'll go to the high 3s to 4 or beyond. But here's the point. At 3.75% on the 10-year, which is not that far away and is easily conceivable given what I've described about the fundamentals, the point is that S&P 500 expense for interest jumped from $16 a share last year to $36 a share with interest rates, 120 basis points higher. Now, that's $20 of increased interest expense per share. That's easily what people are talking about for the tax cut. So what I'm saying is we got earnings stalled out. We got a business cycle long in the tooth, struggling to move forward. We've got earnings that I think are going nowhere and have been going nowhere. And the market is just priced for protection. And I'll tell you, perfection, and I'll tell you, accidents are going to happen. And there's a lot of illusory hopium out there about why all of this makes sense.
David, but I got to challenge you on this a little bit here. First of all, none of the economists that we speak to on a kind of regular basis are foreseeing any kind of a recessionary environment. The economy is growing, not gangbusters, but it's still growing. There is a stimulus play in kind of motion right now. And you've also got corporate sales. Forget about earnings. Corporate sales are growing by 8% year over year. At least that's what this past earnings season has told us. So how can that lead to this kind of cataclysmic environment that you're talking about?
Because you're talking about a rebound from a deep valley in 2016 and 17 that was the result of the global commodity industrial deflation. I'm telling you, sales and earnings on a 3, 4, or 5 year basis aren't growing at all. I just gave you the number. For 2017, GAAP earnings were $109 a share. Back in September 214, GAAP earnings, LTM, were $106 a share. That isn't growth. And second, I didn't say when I thought it was going to happen. I said I think you're going to have a massive yield shock, and that will offset in S&P earnings almost all of the effect of the tax cut. And people are not factoring that in. It's kind of skunk in the woodpile that everybody's ignoring.
Now, David, I know that Anthony Grisanti wants to jump in here. Grizz, what do you got?
Yeah, hi, David. You know, David, I understand what you're saying, but if yields start to rise, we get the big sell-off in the equities market. Doesn't it make sense, or doesn't it stand to reason that investors would come in and start buying the 10-year because they see the attractive yield, and it kind of puts a cap on it as a hedge against the falling equity prices?
Well, I don't think so now, because we're in a totally new ballgame. Paradigm shift. The Fed is pivoting to quantitative tightening. They are actually draining cash, will be at a $600 billion rate out of the bond market. The ECB will be done with QE by the fall. All around the world, central banks are going to have to be going to neutral or actually QT. That will create a different pricing environment for the bond market, because once the smart people see that the Fed is basically selling down its portfolio, they're going to start selling the bond too. That is, they're going to short what the Fed is shorting. That is not factored into the picture, and it's opposite, really, of what they were doing during QE. They were buying what the Fed was buying, and that caused the price to go up even more and yields to go down. We're on the other side. This market is going to way overshoot as it faces this massive fiscal crunch that I just described. 2018 is going to get worse after that, and we have a government that is totally not dysfunctional when it comes to fiscal policy. Trump doesn't care. The congressional Republicans have basically betrayed everything they believe in, and the Democrats are happy to pile on whatever spending they can get their hands on.
All right, David, we've got a few moments here. I got to ask, what needs to happen, in your opinion, for us to avert this scenario, this downside scenario that you're talking about? What do you need to see in the markets or in the government or from the Fed or from anybody else?
Well, they would have to be willing to repeal a big share of the tax cut that they irresponsibly put into place. They would have to be willing to say to the Pentagon, you don't need the $80 billion more, you got too much already. But I want to tell you, none of that's going to happen. Trump isn't going to do it. The congressional Republicans, are kind of resting on their wars. They passed this ridiculous tax cut that nobody can really afford. So I think the die is cast. We are drifting to, if you don't want to call it an iceberg, call it a debtberg. That's what we have in front of us. And there's no relief on the horizon, because it's built in now, and it's not my number. Everybody will tell you that looks at it. $15 trillion of new debt over the next 10 years.
Gotcha.
I mean, this is, it's pretty bad.
It is. A debtberg is something I will be looking at very closely. I'm going to picture icebergs and debtbergs along that same vein. Thank you so much, David Stockman, former OMB director under President Reagan, for joining us here on Futures Now.